Welcome to this recording. This is the Academy of Tax Law Hive Moon. In this session, we're going to take a look at a fascinating and important transfer pricing case. 3M versus the Commissioner of Internal Revenue from the USA. If you're a tax professional or part of a multinational enterprise, this case has important implications for you, especially if you deal with cross-border transactions and transfer pricing. The 3M case raised key questions about US transfer pricing rules and how they interact with foreign legal restrictions. We'll walk through the background of the case, the core dispute, the court's findings, and the final outcome. Stay tuned until the end when I'll highlight the broader impact this decision may have on multinationals and global tax planning. By the end of this video, you should clearly understand how US transfer pricing rules apply to cross-border transactions and how this decision could shape future tax disputes. The original summary was written by Dr. Daniel N. Erasmus. This recording is by Gilbert Ferreira of the Academy of Tax Law. Please click the subscribe button below to receive future recordings from the Academy of Tax Law Hive Mind. If you have any questions, you can send them to contact@academyoftaxlaw.com. For a full summary of the case, please see the link in the description below. But for now, I will just run through the summary quickly. In 2006, 3M, a massive multinational corporation based in the United States, faced a major transfer pricing issue with the IRS. For some background, 3M operates through numerous subsidiaries worldwide. One of these is 3M Brazil. 3M Brazil was using some key intellectual property, or IP, owned by the US parent and its other affiliates. This included things like trademarks, patents, and non-patented technology. IP is a huge part of how multinational companies operate. They license out these valuable assets to their subsidiaries, which then use them to run their business in other countries. For example, in this case, 3M Brazil used these trademarks and technologies to manufacture and sell its products in Brazil. Here's where things get interesting. In 1998, 3M and 3M Brazil executed 3 different trademark licensing agreements. Under these agreements, 3M Brazil was supposed to pay the US parent royalties of 1% on sales of each trademarked product. This is fairly typical. Companies charge royalties to their subsidiaries for using the parent's intellectual property. But here's where the problem arose. Brazilian law, specifically Brazil's law number 8383/1991, places strict limits on how much royalties and other payments can be sent from a Brazilian subsidiary to a foreign parent company. In fact, Brazil's law caps these kinds of payments at a very low percentage to ensure that money stays in the country and isn't excessively shifted abroad. According to this law, 3M Brazil couldn't pay more than a certain amount in royalties for the use of the intellectual property. Despite these restrictions under Brazilian law, when 3M filed its US tax return for 2006, the IRS took issue with the royalties paid by 3M Brazil to its US parent. The IRS said that the royalties paid weren't sufficient under US tax law, specifically Section 482 of the Internal Revenue Code, which requires companies to charge an arm's length price for intercompany transactions. Essentially, the IRS claimed that 3M Brazil should have paid much higher royalties to the US parent, even though Brazilian law wouldn't allow that. In response, the IRS issued a notice of deficiency, claiming that 3M underreported its income by more than $23 million because it hadn't charged high enough royalties for the use of the intellectual property. So, what was the core dispute here? The heart of this case revolves around the conflict between US transfer pricing rules, particularly Section 482, and the legal restrictions imposed by Brazilian law. Section 482 of the US Internal Revenue Code requires related parties in different countries, like 3M and 3M Brazil, to charge each other arm's length prices for goods, services, or intellectual property. An arm's length price is essentially what 2 unrelated parties would agree on in a free market. The IRS argued that the royalties 3M Brazil paid to its US parent for using the trademarks and IP were not arm's length. They said the royalties should have been much higher, even though Brazilian law imposed strict caps on these payments, but 3M disagreed. They argued that Brazilian law should be considered when determining whether their transfer pricing was appropriate. After all, 3M Brazil couldn't legally pay higher royalties because of Brazilian restrictions. They argued that the IRS's adjustment should reflect the maximum amount that 3M Brazil could have paid under Brazilian law, not the higher amount the IRS was claiming under US law. Now, US tax regulations do allow foreign legal restrictions to be considered in some cases when determining transfer pricing adjustments. However, the IRS argued that the Brazilian restrictions didn't meet the requirements set out by US regulations for foreign restrictions to apply. This led to the big question for the court. Should the Brazilian legal restrictions on royalty payments be considered when making a transfer pricing adjustment under US law? The US tax court ruled in favor of the IRS. The court concluded that Brazilian legal restrictions on royalty payments couldn't be considered when making the transfer pricing adjustment. Why? The court's decision was based on US Treasury regulations under Section 482. According to this regulation, foreign legal restrictions can only affect transfer pricing adjustments if they meet several strict requirements. These requirements include being publicly promulgated, generally applicable to all similarly situated taxpayers, and having an effect on uncontrolled taxpayers in similar circumstances. The court found that the Brazilian restrictions did not meet these requirements. One of the main reasons was that these legal caps were not publicly available in writing and were applied in a discretionary manner by the Brazilian government. The court rejected 3M's arguments that the Brazilian law should reduce the IRS's adjustment. In the end, the court upheld the IRS's position, confirming that 3M's income should be increased by over $23 million to reflect the arm's length royalties that 3M Brazil should have paid under US law. So what does this all mean for multinational enterprises and tax professionals? Firstly, the 3M case serves as a clear reminder that US tax law, especially Section 482, applies strictly, even when foreign legal restrictions exist. Multinational companies operating in jurisdictions like Brazil, where legal caps on payments to foreign parents are common, need to be prepared for potential US transfer pricing adjustments. The US Treasury regulations are quite strict when it comes to recognizing foreign legal restrictions, and only under very specific circumstances will these restrictions be considered. Secondly, this case underscores the importance of preparing robust transfer pricing documentation. Multinationals must ensure they have clear documentation supporting their intercompany transactions and showing that they comply with US arm's length standards, even if local laws impose different limits. Thirdly, for tax professionals, the case is a reminder of the tension between local laws and international tax obligations. It highlights the need to be aware of both domestic and foreign legal environments when advising clients on transfer pricing matters. Don't forget to check the description below for the full written summary and a link to the official case judgment. Also, let us know in the comments, how do you think this case could impact multinationals operating in restrictive jurisdictions like Brazil? What would you do differently in this situation? We'd love to hear your thoughts. Thanks for watching, and if you found this breakdown of the 3M case useful, please subscribe to our channel. We'll continue covering important international tax cases and transfer pricing updates, and I'll see you in the next video.